Hello and welcome. Thank you for joining us on the midweek edition of Business Incorporated. I'm Chimezie Obi Iwago. On the program today, Ghana seeks better terms for its debt support program with the International Monetary Fund. And Congo Republic to start producing 50,000 barrels of oil per day from its Bonga Kayo field from the end of this year or early next year. Plus, South Africa's market down despite positive inflation numbers. Let's get started now. We're beginning with the markets here in Africa. South Africa's market was trading lower at intraday despite the country's headline consumer inflation slowing more than expected to 5.3% year-on-year in April from 6.1% in March. On month-on-month basis, inflation fell to 0.1% in April from 0.6% previously. Core inflation, which excludes the prices of food, non-alcoholic beverages, petrol and energy, slowed to 4.8% year-on-year in April from 4.9% and fell to 0.2% on a month-on-month basis from 0.7%. And looking at those numbers here in Nigeria, the market was in the green at intraday, a day after the MPC took a do-nothing decision on its interest rates. And Egypt's market was up after the government indicated it will tap international debt markets for the second time in just 5 months, offering investors a chance to buy more of the dollar-denominated Eurobonds it sold in January. Kenya closed in the red on Tuesday. And in the Middle East, shares in companies linked to tourism underperformed in Dubai in an otherwise flat regional market at intraday. Dubai's theme park operator and constituent of the MSCI emerging market benchmark, DXB Entertainment, lost 2.2% to 0.789 dirham, its lowest price since January 2015. Its shares been hit hard over the last few sessions as investors expect Ramadan and hot summer weather may reduce footfall at its Dubai hotels and theme parks. Ema Malls was down 1.9% after the retail arm of Ema Properties said it will buy a 51% stake in e-commerce fashion website in Mamshi from Global Fashion Group, a startup set by Rocket Internet for $151 million. Dubai's index was down 0.36%. In Abu Dhabi, the index was down 0.30% with main support from the two largest listed shares. Meanwhile, Qatar's index edged down 0.27% with Islamic lender Masraf Al Rayyan, which has been rising since for 6 straight days, dipped 0.9%. In Saudi Arabia, the index was down 0.28%, with the majority of trade focused on small and mid-sized stocks. And in Europe, investors are digesting credit rating agency Moody's decision to lower its rate on China to A+ from AA3, arguing that Beijing will erode its financial strength somewhat in the next few years. U.S. President Donald Trump is also in the news. Let's talk to my colleague in Frankfurt, Conrad Bussen, to know how these are playing out in the markets. Good afternoon, Conrad. Thank you very much for being with us again. Now, Moody's has just downgraded China's credit rating. How are the markets trading this development in the face of positive economic trend reported in Europe's two largest economies, Germany and France?
Well, Jimmy, of course, this strong economic trend in Germany and France is a big support for the stock market here. Also for the currency, the euro-dollar exchange rate is relatively high. This downgrade of China by Moody's is, of course, a much discussed topic on the markets here in Europe today. It's not really having an impact on prices, and that has very much to do with the fact that the majority of those loans, the biggest chunk of the credit in China, is held by domestic investors. The amount of debt held by creditors which are not from China is relatively low compared to international standards, only about 12% according to numbers by the International Monetary Fund, which means that this downgrade isn't likely to be as disruptive as it would have been in the case of a country more dependent on international funding. Something else is, well, maybe not perfect news for China in regard of this Moody's downgrade, but from a point of view of people on the markets, Moody's says that the outlook for the credit rating for China was stable now and not negative, so it's very unlikely that we're going to see another downgrade within the next 6 months.
All right, let's see what Donald Trump has been doing. Of course, he has concluded his overseas tour, and of the lawmakers on Capitol finalizing the $4 trillion next budget. What are you gleaning from the ongoing budgeting process?
Well, people I talk to here would like to see how this budget proposal will pass through Congress. After all, Donald Trump proposes huge cuts, of social benefits like Medicaid, children's health insurance programs, federal student loans, and other welfare programs. So it's quite likely that not all of this budget proposal will be overwhelmingly welcomed by all members of Congress. And there's something else. This budget proposal reckons with high savings due to economic growth. So the economic growth that Trump has announced will have to materialize in order for this budget to work. What we've seen so far since the election of Donald Trump is a huge increase of business confidence, of sentiment on the markets, but we haven't seen yet a strong real economy. The economy is doing well in the US, but it's not better than before Trump's election, and this will have to change in order to really make those growth rates and the cuts that Trump wants to finance by growth possible.
All right, back to where you are. The European Central Bank is set to publish its latest Financial Stability Review report. What are you looking to see in this report?
Well, the Stability Report has just come out, and it contains a few positive aspects and also a few warnings. Let me start off with the positive things that the ECB has to say. It says the financial system has shown that it's quite resistant to stress, that it's likely that the banks have left the point of super low earnings behind them, and that gradually earnings would look better in the months and quarters to come. As a consequence, the pressure on the banks from the side of investors has eased somewhat. But there are also risks, the ECB says, and those have to do with the relatively high debt of some of our Eurozone countries. In case of political uncertainty, the ECB sees the risk that those European government bonds would see an increase of the risk premiums. So, whether or not this is a warning, a hidden warning to the officials and the governments of the Eurozone for how they are treating Greece at the moment, I don't know, but sure, this is an indicator and a warning by the European Central Bank that there are risks out there in terms of the high debt levels of our countries, and that the currency union, in order to have to work, there will have to be a lot of work done yet.
Well, I guess there's a mixed feelings out there. Thank you very much for your time, Conrad. We move on.